Well, good afternoon. My name is Carlos Da Costa, Chair of MES, and on behalf of CIM MES, we would like to welcome you to today's MES discussion group meeting. For those of you who don't know who CIM is and CIM MES are, the Canadian Institute of Mining, Mineralogy, Petroleum Association is a nonprofit technical society of professionals in the Canadian minerals, metals, materials, and energy industries. CIM's members are convened from industry, academia, and government, and the Management Economic Society, aka MES of CIM, provides a home within the CIM organization for mineral industry professionals whose focus is mineral economics and management. Members are from all areas of professional endeavor, and all are welcome. So more details will come with regards to that. For Wednesday, July 12th discussion group seminar, CIM MES is pleased to welcome Fred Pletcher, Chair of BLG's National Mining Group and a partner in its Securities and Capitals Market Group, who will deliver a presentation on transactional and legal trends in the mining industry. Okay, if you have any questions throughout the presentation, please type them in the chat box, right, in the menu that's located in the toolbar. They will be answered at the end of the presentation during Q&A. So without further ado, I will let Fred take over.
Great. Thanks very much for that, Carlos. Let me try my screen share here, as I've got some slides for you. Tell me if I have got the slides working.
Sounds good.
Are they up?
No, not yet.
Right, yeah.
Yep.
Perfect. Excellent. Well, thanks all for attending. As the father of three children in their 20s now, and graduating from various graduate schools, I always like to start with a dad joke. So the dad joke for today's session is, what did the hipster say to the miners at the protest? The answer, I liked you guys better when you were underground. So with that metaphor in mind, we're going to unearth a few transactional legal trends in the mining industry. So let's just. My slides ready.
Okay. Try putting from the beginning. Click on the menu bar beginning, and then just use the arrow keys.
Okay, here we go. So we're going to touch base on some recent public M&A trends in the mining industry, particularly gold, copper, and critical minerals consolidation. Talk about some royalty and metal streaming trends, and then derive some legal and transactional trends for them. Talk about some interesting and very sizable ESG-driven transactions, and then talk about a break on some M&A transactions from increased foreign investment scrutiny in Canada. We'll talk about some indigenous consultation issues throughout the Americas, and then just touch briefly at the end on increasing mining nationalism globally. So to start out, I'd like to acknowledge that there's been a spate of consolidation within the mid-tier and higher in the gold industry over the course of the last 4 years. It started with Barrick's zero premium merger with Randgold, which was quickly followed thereafter by Newmont's acquisition of Goldcorp. And that sort of established, who the two main players continued to be in the gold sector. Then here in British Columbia, another significant transaction that year where Newcrest acquired 70% of the Red Chris copper gold mine from Imperial for about $1 billion expenditure. There was a little thing called COVID that stopped some M&A. in 2020 and 2021. But in 2022, things picked up again. Newcrest again dipped their toe in British Columbia with their acquisition of Pretium and its Brucejack property. And then a very significant transaction between Agnico Eagle and Kirkland Lake, establishing Agnico Eagle as the third man on the totem pole in terms of global gold producers. Later on that year, Gold Fields, the fourth largest producer, entered into an agreement to acquire Yamana, was ultimately unsuccessful because Agnico Eagle remained active in the market and teamed up with Pan American Silver to launch a successful topping bid for Yamana. Yamana's assets were then divided between Pan American and Agnico Eagle, with Agnico Eagle taking the Canadian assets, particularly the 50% of Malartic they didn't own, and Pan American Silver taking on the Latin assets. And then finally, this year's largest transaction, Newmont's initially hostile proposal to acquire Newcrest in Australia, which has been accepted by Newcrest and will result in Newmont being clearly top dog in terms of global gold producing companies. So why all the consolidation in the gold space? Part of the rationale is that the gold industry is the most fractured of all the major metals commodities. And, you know, the top 10 producers in the gold industry only generate 20% of the production, which is very different than more concentrated commodities, iron ore, nickel, zinc, where the major producers produce a lot more of the world's products. So gold is an area that was sort of crying out for consolidation. The other drivers are achieving scale. You know, in a capital-intense industry like gold production, scale is always important. It's even more important if you're in a modestly inflationary environment with increased debt costs. Another driver for these transactions was geographic diversity, but with a bit of a qualifier into safe or familiar geography. You know, certainly Newmont's acquisition of Newcrest is in part because 4 to 5 of Newcrest mines are in tier 1 safe mining jurisdictions, Canada and Australia. And Newmont was willing to pay a little bit of a premium for entry into those jurisdictions. Geographic diversification, where it's not familiar or safe geography, has been less well embraced by the markets. And an example of that would be Gold Fields' unsuccessful attempt to acquire Yamana. Now, certainly this was diversifying Gold Fields' portfolio, but investors in Gold Fields in particular didn't quite understand the strategy of moving into jurisdictions like Canada or Latin America, where Gold Fields did not have an established footprint. Those concerns weren't there with respect to Pan American and Agnico Eagle's offer, because Agnico Eagle is very familiar with the Canadian marketplace and particularly familiar with the Malartic mine, and Pan American's been operating in Latin America for over 30 years. So diversification good, but into safer, familiar geography. There's also been a focus on diversifying commodities. Now, you may say, it's a bit odd in the gold space. 20 years ago, gold companies were all afraid that they might inadvertently become copper companies. But with the strength of copper prices and the role that copper will be playing in transition to a green economy and electrification, gold companies don't mind moving the needle a little bit in the direction of copper. And that's evidenced again by Newmont's statements with respect to their acquisition of Newcrest. They said part of the reason is to get a bit more exposure to copper. And it's certainly part of the rationale for Barrick kicking the tires, as has been recently disclosed that they did with respect to First Quantum. The other driver, of course, is just replenishing project pipelines. Mid-tier and major gold producers have had declining reserves for a number of years. And that's a global problem. Over the past 20 years, the amount of global gold reserves have increased on average less than 1% a year. And although that might seem like some growth, most of that growth has been in 3 jurisdictions: Russia, China, and Kazakhstan. And having worked in all 3 of those jurisdictions, I can say that they're a challenge, and more so today than they were, say, 5 or 10 years ago. So Western companies accessing Western gold reserves are finding themselves in a geographic constraint on shrinking reserves. There's also been amongst the majors and the mid-tiers a bit of a reluctance to invest in major costly greenfield projects. Now, certainly there are exceptions. Barrick's second go at Pakistan, will be very capital intensive. But many of the majors and mid-tiers got their fingers burned and were punished by the market for projects that had massive cost overruns 10, 15 years ago. And they're unwilling to get their fingers burned again. And an M&A transaction may provide, even though there may be a premium involved, a little more stability of price and predictability than the uncertainty of greenfields project, especially in a modestly inflationary environment where capital costs are increasing. The other driver that's helped the consolidation here, gold prices have been largely stable for the last few years, above $1,600 an ounce, and that's added a little bit of powder to the gold companies' pockets. Notwithstanding the improved balance sheets of most gold producers in the mid-tier and the major side of things, the interesting thing is most of these acquisitions have been financed with equity. Sometimes there's a cash component, but it's largely equity, despite these producers having the balance sheet to finance with debt. And that has an important corollaries that we're going to get to. And then the other issue is premiums are back. At the time of the Rand Gold and Barrick merger, people were talking about zero premium deals as the wave of the future. Investors certainly liked them. A lot of investment bankers were telling you that's the way deals should be structured. Not so anymore. Premiums clearly seem to be back. One of the challenges with the consolidation is, the deals that I listed were for producing assets in the over $1 billion category, and it involved mid-tiers and majors. The M&A wave has not generally trickled down to junior insurers as of yet. Now, certainly mid-tiers that weren't engaging in larger transactions with their peers have acquired development and advanced exploration projects. Think Kinross's acquisition of Great Bear, B2 Gold's acquisition of Sabina. So certainly there have been mid-tier players who are acquiring some of the more advanced projects from junior development companies, but it hasn't really amounted to a lot of acquisitions in the junior space by the majors and mid-tiers. Now, the juniors are able to benefit from the M&A wave in that, generally following the large M&A transactions, there's a potential for spin-offs and rationalizations. And we've seen juniors take advantage of those, oftentimes bring themselves into production. Good example of that would be Bear Creek, a non-producer's acquisition of the producing Mercedes mine in Mexico from Equinox, following Equinox's acquisition of Cream. So the opportunity to take advantage of some of the majors and the mid-tiers transactions is there. One of the things I suggest, if you're going to try and get yourself involved in a spinoff, strike while the iron is hot, because one of the things that makes a spinoff attractive is it avoids the cost of integrating that project into a company's existing portfolio. And if you wait too long and that integration process is gone, the spinoff becomes less attractive for the company. Copper industry has had a similar degree of consolidation, more so in the most recent year. But in 2022, copper M&A outpaced gold M&A for the first time in 4 years, driven by BHP's acquisition of Oz and Rio Tinto acquiring the 49% in Turquoise Hill that it didn't already own, which gave it a 66% stake in Oyu Tolgoi. And then we saw Metals acquisition acquiring the CSA mine from Glencore. This year, there's continued to be a lot of activity in the copper space, particularly Glencore's multiple unsolicited offers to acquire Teck Resources, which of course have been rebuffed by Teck. Lundin announced an acquisition of 51% interest in the Caserones mine from a Japanese enterprise, and Hudbay announcing the acquisition of Copper Mountain Mining. So also consolidation in the copper space. And that's driven by copper's central role in the green energy transition. Much like gold producers, copper producers need to replenish their project pipelines. Unlike gold, depending on which analyst you're talking to, there seems to be a near and midterm structural deficit globally in terms of copper production. And when that may trickle down to some of the capital-intensive large copper projects that juniors own that have not been up for sale recently, it may reach that point at some point, but it hasn't been occurring now, as the majors and the mid-tiers have basically been acquiring themselves as part of this process. And that's all been made easier by extremely strong copper prices recently, which has really given a lot of firepower to the copper players and allowed them to afford some of these acquisitions. Similarly, seeing a lot of M&A in other critical minerals, particularly looking at lithium here. We saw a hostile takeover for Liontown by Albemarle. We saw Livent and Alcan agree to an all-stock merger of equals. The interesting thing going on in lithium, though, is more the supply transactions, where they're getting very significant funding from producers within the auto sector. So Liontown's 3 deals in 2022 with Tesla, Ford, and LG. Lithium America's lithium supply deal with General Motors to help develop Thacker Pass in Nevada. And then Ford had 3 big deals with Albemarle, SQM, and Nemaska Lithium here in Canada to secure supply. Again, lithium obviously is a central role in the green energy transition. For lithium as an industry, the concern is less the availability of lithium reserves and lithium for mining. The bottleneck is onshore lithium processing. 80% plus of lithium processing right now goes on in China. And as part of Biden's Inflation Reduction Act, they've been providing financial incentives to onshore lithium processing in America and its allies. And those incentives have been part of the genesis of companies like Borden GM helping to finance lithium producers. Certainly, there's been a softening of lithium prices this year. Demand, though, is still expected to increase long-term. And the relaxation of the lithium price may, in fact, spur on a little bit of M&A as the companies are not valued at the stratospheric levels that they were last year. In terms of the legal and transaction trends that flow from the developments in these spaces, I'll make a few general observations and then point to some things that clients in the mining industry are asking. So the first thing is, this is a seller's market. It's quite frothy. There's a lot of volume in terms of transactions. Again, it's a seller's market, the mid-tier and up. And the question is, will that trickle down to the junior space? But for now, it is a seller's market. And what we're seeing in connection with transactions or proposed transactions or initial discussions is, like most cases in a seller's market, where you have a lot of parties who may be interested in assets, there'll be a pressure on due diligence and exclusivity. And the time frames for diligence and the time frames for exclusivity will be shortened, because if a transaction isn't happening, there are other parties who will be interested. One of the other things we've been seeing in the course of the last sort of 12 months or so is more seller-friendly representations, warranties, and covenants in M&A transactions. There's been a decided shift. If you're thinking of doing a deal and thinking of providing a very buyer-friendly first draft, you're not going to get very far these days. We're seeing a lot of very interesting seller-friendly terms and conditions. Now, when you have a seller's market and you have a truncated initial period of the transaction before signing, that can lead to integration challenges, because if a deal takes a while to be fleshed out and completed, it gives the parties time to suss each other out, determine where their strengths and weaknesses are in their respective management teams, and plan out how to integrate the two entities and management. Where you're rushing towards a signing, you don't have that opportunity there will always be the temptation to put integration issues on the back burner and deal with them after signing, or in some cases after closing. Where it's on the back burner, you can have misses, and it can give rise to issues in terms of personnel, culture, how portfolios fit, management of significant assets. And certainly we've seen in a few of the deals over the last few years, an initial management team formed that includes management of the target and management of the buyer put together. And then those roles change within a month or two because the deal was hurried. There wasn't an understanding perhaps of some of the cultural differences within the two organizations, and changes had to be made in terms of integration. So even though you may be rushing towards a transaction, try to keep the top integration issues top of mind and not let them slide into the later part of the transaction, where you may find yourself in a somewhat embarrassing situation where there's an integration problem going forward. One of the other takeaways from the fact that it's a fairly frothy seller's market these days is amongst those in the mid-tier and the senior areas, there are bandwidth issues in terms of corporate development and their ability to do, the ordinary run-of-the-mill transactions that we commonly see from these issuers. As a junior, you often think, geez, these majors have large corporate development divisions. They're always going to be able to answer my phone. This is one of the reasons why I want to work with them. The problem is if the company you're dealing with is facing an existential larger transaction, they will have problems answering your phone calls. And we've seen a number of transactions of late sort of pushed off because the mid-tiers and the major, frankly, have had bigger fish to fry and haven't paid quite as much attention to joint ventures or commercial arrangements that they typically would were it not a frothy M&A market. So if you're not getting your phone calls returned, don't take it as a personal affront. They're probably suffering some bandwidth issues. And parties entering into transactions with companies that are engaging in some of the restructuring and M&A transactions going on should understand that there may be bandwidth issues and be prepared for that. One of the other things that we've seen recently in the mining space that we see more often in other industries, particularly things like real estate, is syndicated acquisition groups occurring. That's more than one purchase. In other industries, you see combinations with pension funds, with private equity funds, with infrastructure funds working alongside strategic investors. In the mining sector, we've seen a few of these now. You think of Cameco's sort of joint work with the new Brookfield fund to acquire Westinghouse. Now that's vertical integration, a little bit different than mining company acquiring a mining company, but you see how it was done in combination. Similarly, Pan American Silver and Agnico Eagle making a joint bid for Yamana, another example of syndicated transaction. Now, it's interesting because Agnico Eagle and Yamana acquired their interest in Malartic when they made a syndicated acquisition of a Cisco. So this stuff is occurring in the mining industry. If you're an acquirer, a syndicated acquisition can bring a lot of benefits if there are some strategic aspects of the target that don't quite mesh with the acquirer, or the cost of acquiring the target may be a little beyond the acquirer's means. It may be that some portion of those assets may be strategic for a potential partner who may be able to fund a little bit of the transaction. And that allows a deal to become doable that otherwise wouldn't. Now, for the acquirer, they've got to put work in on the front end, and you have to negotiate a cooperation agreement between the syndicate members before you put a hard and fast offer in front of the target. And that's a little bit of work. And it means there's always an initial negotiation internally amongst the syndicate before you have the negotiation with the target. So it leads to a more complicated transaction, but the benefits associated with a wider universe of potential targets is certainly helpful. On the seller's side, if you're in a situation where you're trying to expand upon a strategic process or a white knight search, considering syndicated acquisitions as opposed to acquisitions from a single acquirer gives you a broader universe of potential counterparties to sell your asset to. There are risks, though. As you add multiple parties, you increase closing risks. And there are two ways of structuring these transactions. They come in two different flavors generally. There's a seller-friendly flavor, which is that the syndicate all give representations, warranties, and enter into contractual covenants with the seller. That's the sort of joint structure. And that is quite comforting to the seller. We've got both acquirers on the hook. The other structure is a back-to-back structure where only one of the acquirers directly contracts with the seller, that acquirer contracts with the other acquirer, and the transaction is closed simultaneously. It's a bit almost like a financing condition. The seller is protected from the second deal collapsing on the basis of some reverse break fees that would be agreed to. But the seller would never be in a position to obtain, say, a Cineplex type award if one of the parties walked away. It's really going to be limited to those reverse break fees. And that's very much an acquirer-friendly form of syndicated acquisition. We've seen these now several times in the mining industry. We'll see them again in the future. Keep them in mind. But the other trends we can take away from the spate of transactions is hostile transactions are back. There have been a lot of them. And for a while, we didn't see a lot of hostile transactions in Canada. From 2016 through about 2021, the number of hostile transactions was down 50% from what it was the 10 years previously. So this is a bit of a shift. And with hostile transactions come a host of issues, both from a governance standpoint in terms of a response standpoint, that make the transactions far more complicated, increase costs dramatically, and make them much higher stakes than friendly bids. Now, if hostile transactions have been rare recently, topping bids have been even rarer. And yet we've seen one recently in terms of the Pan American and Agnico Eagle topping bid for Yamana. So we're seeing those sorts of transactions, and both hostile and topping bids are really symptomatic of a frothy seller's market. You don't see them as much in press marketplace. Now, when we structure our transaction, lawyers and investment bankers and mining business development people spend an inordinate amount of time preparing deal protections to address the threat of a topping. And those deal protections are confidentiality provisions, a no-shop, a fiduciary out, a right to match, and then a break. And that's all well and good, and it's designed to prevent topping bids. But topping bids aren't, notwithstanding the Pan American Agnico Eagle example, haven't really been as much of a problem as the main impediment to transactions moving forward in the last 10 years, and that is M&A activism, where shareholder activists come in and exert influence on the structure of transaction. And that M&A activism can take many forms. It can be what's known as bumpitrage, where the activist threatens to withhold votes in exchange for an increase in consideration. It may actually just be shutting down a transaction that the activist does not agree with strategically, and that it will benefit the activist because the hedging position they will take on the acquirer. And if the transaction doesn't go through, the acquirer's price will pop up and the activist will make a goodly killing. And then other transactions can be activists forcing companies into sales, into spin-offs, and they've been very effective at it. In the last sort of 10 years, M&A activism has amounted to about a third of Canadian activism. Prior to 2021, the activists were on par, generally winning. A little bit more than half of M&A activism files, the activists were winning. Last couple of years, it swung a bit back and management has been a bit more successful. But activists are winning their fair share of these contests. So when you're planning your transaction, don't become overly concerned with a topping bid. Get your ordinary deal protections, but give some real thought to the potential for M&A activism, given your knowledge of your shareholder base given the strategies of the companies involved in the transaction, and given what you know about shareholders in the company. Just touching on some other legal and transaction trends from the consolidation. How do you defend against hostile bids and activism? The foremost way to defend yourself is through a good, active shareholder engagement campaign. When I get brought in on activist files for a company or on hostile files for a company, first question I ask is, who are your top 20 shareholders? What do they think about your company? And more often than not, the answer I get back is, well, we don't really know all of our top 20 shareholders, and some of them we probably haven't spoken to in a while. Well, the answer is that's why you're probably facing this situation. Your best protection against hostility and activism is to have an engaged shareholder base that you are in frequent communication with, who understand what the company's strategy is and are in agreement with it. And if your shareholder base is not in agreement with your strategy, change it. The other thing is that your shareholders need to have met and have a good relationship with the independent directors of the company. You have to have met with them separate from the CEO, no chaperone. And you have to be able to give your significant investors the sense that your board of directors is truly independent, has the shareholders' interest at heart, and they aren't just a bunch of cronies beneath. The problem with hostile deals and M&A activism is once an unsolicited bid has emerged and once an M&A activist has popped up, from that moment on, all communication from the CEO, the company, and the board will be suspect. The assumption by investors will be that they're hanging on for their jobs. So you have to have done the shareholder engagement ahead of time. You have to have been proactive with it. After the hostile party has emerged, it's probably too late to do a lot of effective engagement. One of the legal approaches that has been thought to ward off property bids, which we've seen now in a few mining deals, are force the vote mechanisms. I'd like to just touch on them. They appeared in the Agnico Eagle acquisition of Kirkland Lake. They occurred in the Goldfields offer to Yamana. What a force the vote mechanism provides is, even if a topping bid is made, and even if the board of directors determines that topping bid is a superior proposal and recommends in favor of that topping bid, the board, and you don't exercise your right to match, the board's determination not to support the inferior bid doesn't lead to the meeting being canceled. The shareholders have to vote down the inferior bid for the agreement governing the inferior bid to be terminated, and for the superior bidder to be able to enter into an acquisition agreement with the target. So essentially, it gives the inferior bidder 2 kicks at the can. And that meeting isn't going to be a fair fight, because the inferior bidder will have absolute free rein under the agreements to aggressively solicit proxies and use social media to get its message out there. The bidder is likely to be subject to confidentiality and possibly a standstill agreement with the target if they gain access to due diligence that will restrict them from making any statements. So they'll have to be stony-faced and silent in connection with that meeting, other than their initial press release announcing their deal. Similarly, the company will be able to recommend that shareholders vote against, but will not be able to actively solicit proxies against. So it's a one-sided fight. And the thought is that would prevent topping. Now, force the vote mechanisms have traditionally been pretty rare. They're viewed as bad corporate governance. They're only given where an excessive premium is generally paid. But the thought is they'd ward off topping bids. Now, the interesting thing with the Goldfields Yamana example is the force the vote mechanism was there, and it didn't work. Goldfields' initial position was they weren't going to match. They thought that their offer was better. They would take it to shareholders. That was their view on Friday. By Monday, they had thrown in the towel and had terminated the transaction unilaterally. what was the change? They spoke to their shareholders who were not in support of Goldfields continuing their prosperity now. So interesting that we now have a practical example of how forced the vote works. And the answer is, it doesn't really. Now, there is a hypothetical where it could work, where, a board of directors, picks a really inferior transaction and tries to label it superior. But the chances of that happening are low. So it'll be interesting to see whether after the Goldfields transaction, we'll continue to see force the vote mechanisms in Canada. As I said, they're not considered good governance. And interestingly, the Delaware courts have shot down force the vote mechanisms in a few instances. Because mining deals of late have largely been all equity deals, all stock for stock deals, acquirers have to consider when they're making an acquisition the effect of that on their own position. If it's a significant enough transaction, they will likely have to go and get their own shareholder support for the transaction. And they will have to go through an analysis of whether they have had sufficient shareholder engagement that their shareholders are supportive of the transaction. And in the Goldfields Yamana situation, unsurprisingly, there were a number of Goldfields shareholders who were not supportive of the transaction for strategic reasons and otherwise. And Goldfields had a very high threshold to meet under South African stock exchange requirements, is 75% approval. And there was uncertainty whether or not Goldfields would reach that, even without the Pan American and Agnico Eagle bid being on the table. So because so many deals are relying on stock for stock, there's increased voting on both sides, and that opens up transactions for attack. The other question is the amount of settle in the acquirer's stock. In a perfect capital market, the acquirer's stock would decline on an aggregate basis by the amount of the aggregate premium. That's in a perfect capital market. We don't live in that world. And if there are synergies or lack of synergies, that'll apply to it. But generally speaking, an acquirer's stock is going to go down, which will make your offer less attractive than it was when initially considered by the board of the target. And if it declines enough, it will represent a weakness for your deal. And again, that's what happened in the Goldfields Yamana situation. Transaction was announced, Goldfields share price declined significantly, 20%. That effectively wiped out the premium that Yamana was receiving. And then as Goldfields share price declined over the course of the next 6 months, the transaction began to go underwater, which allowed Pan American and Agnico to swoop in with the topping bid that was considered to be superior. Pan American and Agnico were not offering a premium that was similar to what Goldfields was offering at the time of the Goldfields deal, but the settle harmed Goldfields. Now, is there any way you can protect against a settle? Well, yeah, the same transaction gives us a really good example of this. One of the most interesting aspects of that transaction is there was concern about the degree of settle in Pan American stock. Less so for Agnico Eagle because their market cap, sort of dwarfs Yamana's. But there was concern about a settle in Pan American. That was addressed, interestingly, by Agnico Eagle committing to acquire up to $150 million of Pan American stock in the marketplace. And that was publicly disclosed. So it's not market manipulation when it's public. And interestingly, on the day of announcement, the Pan American stock began to decline as you would expect. But by the end of the day, there was a lot of buying. The amount of settle was about 4% at the end of the day, which meant that the Agnico Eagle Pan American bid was clearly superior to that of Goldfields from a financial perspective. So having that sort of support against a settle can really be important in these transactions. So when you're doing stock for stock deals and you're the acquirer, you have to think about your own shareholder meeting. You have to think about how your own shareholders will assess the transaction and think about putting in place procedures to limit the settle and prevent the ARBs and the hedge funds from going to town. Now, with the increase in hostile transactions in the mining industry, we have a lot of clients calling us, asking us if they should dust off their defensive playbooks. And the things that companies look at in frothy markets like this are shareholder rights plans, first and foremost. Now, a shareholder rights plan can't be used in Canada to just say Canadian Securities Commissions made it clear in the Canada decision that they will not extend rights plans beyond the 105-day bid period under the takeover bid rules that's been in place since 2016. Now, there is one exception. The acquirer has engaged in absolutely egregious behavior that is beyond the pale of public policy. Then a plan might be allowed to stay in place. That happened in Interpipeline, interesting in oil and gas space. But generally speaking, pills aren't going to extend. What your pill really protects you against since 2016 is a creeping bid and an acquirer being able to rely on what's known as the private agreement exemption to acquire stock in excess of 20% from 5 vendors at 115% of market price. If you make acquisitions up to 19% and then you use the private agreement exemption, you can quickly get the blocking position for the target. Rights plan prevents that. Once you hit 20%, the rights plan kicks in, unless the offer's been moved to everyone. It's accepted. Advance notice bylaws are important in dealing with activists, prevents the activists from nominating directors from the floor, and gives you some assurance that you're not going to be in a proxy fight for directors at the same time you're in a proxy fight for an M&A deal. And generally speaking, they require 30 to 60 days notice, well accepted now for Canadian issuers. One of the most common forms of defense mechanism is undertaking a strategic review process and looking for a white knight. And generally speaking, hostile acquirers aren't successful. Over the past 20 years, they've only been successful about a third of the time. 2/3 of the time, it's a third party who ends up farming profit. White knights have tended to do well in Canada. Now, the Securities Commissions are the view that 105 days is enough time to engage in an auction process. Realistically, having done enough auction processes in my career, I'll tell you that you need a bit more time. So to squeeze an auction process in the 105 days, if you're faced with something hostile, you have to have your process ready to go from day one. You need to have your teaser ready, to have an electronic data room ready, to have an extremely reasonable confidentiality agreement with a spring in it, ready to go, to have the list of parties that you will solicit. And there are a lot of companies out there whose CEOs have handshake suicide pacts with other CEOs that if someone comes after you, I'll help you, you help me. Surprisingly, right? The CEOs are pretty expensive. Of course, totally fine. Gentle living, simple. So have those procedures ready to go if you're concerned about hostile transactions. Oftentimes, there's a lot of back and forth with a hostile party before a bid is launched, and that gives you a bit more time than the 105 days. Glencore's made a number of overtures to Teck in the public markets. It hasn't actually put a bid on the table, and that's given Teck quite a bit of time to prepare its response. One of the issues when you're concerned as a company, your shareholders throwing you under the bus, is to get new shareholders. And the way traditionally to do that, to help ward off activists and hostile bidders, is through strategic investments, by large parties. And those, are generally speaking investments, 10% or more. They come with shareholders agreement, usually board representation, oftentimes voting at trust arrangements. And those can be useful for warding off hostile parties and M&A activism. Although, as we saw in Teck's spin out of its coal assets, sometimes your strategic investor turns against you, as was the case with the Chinese investment fund. Other options are taking private placements, which can help dissuade a hostile bidder or M&A activist. There are rules in Canada with respect to when you can do a private placement in the face of bid or in the face of activism. The Arrow decision with respect to activism, the Dolly Borden decision with respect to hostile bids. Certainly private placements have been allowed in the face of a hostile bid, but you have to be able to show strong evidence that it was a financing that was in the works prior to the hostile bid emerging. And you have to be able to show quite significant evidence of it. and Dolly Borden inputs was it been shown. One of the other common tactics in terms of defensive playbooks is litigation. And litigation in Canada typically revolves around misuse of confidential information. And sometimes professional advisors, particularly financial advisors, playing both sides of the fence and contaminating the information of both parties. And a number of takeover bids have been halted dead in their tracks in Canada for breach of confidentiality concerns. So certainly there's no harm in playing the field and having a lot of confidentiality agreements out there with your strategic counterparts. The final form of defensive action can be commercial impediments. Think change of control, payment requirements for note issuances, options to acquire crown jewels, rights of first refusal, and change control provisions with respect to major commercial agreements, joint ventures, and the like. Again, the problem with these is we've got national policy 62202 that prevents defensive tactics. And if these sorts of agreements are entered into after the hostile party has surfaced, they're likely to be enjoined or struck in close. Let's turn to ESG-driven transactions for a few minutes, as the world has really shifted with respect to those. Way back in 2020, Larry Fink, in his annual letter to CEOs, asserted his view that climate change risk is investment risk. And he predicted that investors will begin to allocate their capital towards sustainable investing and vote accordingly. The next year, BlackRock put their money where their mouth is. They voted down 255 directors for climate-related concerns, 5 times more than they had the year before, and supported nearly 2/3 of environmental proposals at shareholder meetings, which was a 6-fold increase from the year before. And what Larry Fink had predicted has come true. Many investors are turning to sustainable investing. They are looking at the ESG scores of their investors. It's having an impact on capital allocation. So accordingly, in the last year, we've seen enormous ESG-driven transactions amongst some of the largest players in the industry. You know, the poster child for it here in Canada, obviously, is Teck Resources' spin-out of its coal assets. The intention was to divide up Teck into a base metals company, Teck Metals, and to spin out its existing coal assets to a company that could be called Valley Coal. The rationale being that the base metals company would have an uptick with respect to the base metals role in the green energy transition, why would attract investment. And then those investors who were interested in met coal could invest in a met coal investment. Obviously, the transaction wasn't successful. It didn't receive adequate shareholder approval at Teck's meeting. Now, it was kind of because of a perfect storm of events. You know, Glencore was in there making a hostile offer. There were some concerns with respect to the concurrent collapse of the multiple voting trust structure of the Keevil family and others in Teck that raised some concerns. But a lot of investors were concerned with the structure of the transaction and felt that the proposed division of Teck wasn't happening quickly enough and wasn't an effective enough division. Because the coal assets represent the majority of Teck's cash flow, and Teck-based metals would have need for a significant amount of capital to advance some of its very significant copper projects. The Teck deal had been structured in a way such that Teck-based metals would receive a cash stream from the coal company for a number of years following closing. And investors said, well, that isn't really a division if you're taking the cash flow from coal, met coal, and applying it to base metals. They wanted to see a more decisive division. So back to the drawing board for Teck on that. Now, the interesting thing is that Glencore, who threw a wrench into Teck's plans with its hostile proposals, has its own proposal to do basically exactly the same thing and divide up its metals business from its coal business for the very same reasons as Teck. So again, an even larger colossus within the mining industry contemplating a significant restructuring due to ESG concerns. And Vale, another giant in the industry, is looking at the same thing. They're not doing it for coal. They're thinking of separating out their iron ore operations from their base metal operations, again, because they think there'll be a cleanup associated with separating out those base metal projects. So a lot of restructuring driven by ESG investment, and we will only see more of it as it continues. If the biggest players in the industry are undertaking these transactions, it will inevitably filter down. Now, ESG-driven transactions aren't necessarily always about attracting capital. Sometimes they're fire sales when you have perhaps inadvertently stepped on an ESG landmine. And we've seen a few of those. With the Russia-Ukraine war, Western companies exited Russia, and Kinross unfortunately had to sell its Russia assets at a deeply discounted price to Hong Kong. Similarly, Tahoe Resources took a hit in their share price following a court-ordered shutdown at their Escobal mine in Guatemala to permit indigenous consultation. And at the end of the day, they realized, given the loss of cash flow and production at Escobal, they needed to team up with another producer and diversify and get a bit more production. Hence, they agreed to a deal with Pan American Silver. So again, if your company is subject to a black swan ESG event, you may end up being forced to undertake a transaction to respond to that ESG problem. So again, as ESG continues to be driving the investment community, we're going to see only more and more of these. So companies are thinking about ESG when they're planning M&A activities. Will this deal benefit me from an ESG perspective? Will it give rise to risk from an ESG perspective? Much more so than what's the case in the years. There's been a bit of a break on the frothiness in the market that comes from the Canadian government and our increased foreign investment scrutiny. Back in 2020, the federal government announced that the Investment Canada Act would subject certain foreign investments to enhanced scrutiny. There have been 4 times as many national security reviews from 2020 to 2021 than there were in the 4 previous years. And Canada has specified that critical minerals and investments in critical minerals by foreign state-owned or influenced investors will receive increased scrutiny. Critical infrastructure also. The problem with national security reviews is they're shrouded in secrecy, and it's really uncertain what the government is focusing on. The government may consider the country in which a potential counterparty is located and whether that's an unfriendly jurisdiction. Russia and China would be the 2 foremost examples. Whether the actions of jurisdictions which the counterparty is located are aligned with Canadian ethical standards. So companies active in the jurisdiction with broadly foreign corruption issues, that may lead to national security review. And even the nature of the customers may be subject to national security review. It may seem that you're doing a deal just with an Australian company, but if they're selling all their comm to China, that may impact the Canadian government's assessment. If you're going to make an investment, if there is a foreign investment in a sensitive sector, you'll need to notify in advance the minister to give the minister an opportunity to assess whether an NSR is required. If you don't do that, your transaction can be unwound after the fact, and you'll be once. That sort of damage is hanging over their head. The minister has considerable authority to impose conditions during an NSR review, and NSR reviews increase time for transactions. Usually a foreign investment review is 45 days, and NSR review is 200 days, sometimes longer. So given the opaqueness of the NSR process, you've got to consider NSR issues early on in a transaction. And it's not as simple as, am I dealing with a Chinese state-owned enterprise on the other side? You've got to consider and peel back the layers of the onion a bit. Think about where your counterparty is from, what jurisdictions it's operating in, what's the lay of the land in those jurisdictions. This is certainly slowing down a number of transactions. Another issue that's very topical these days is indigenous consultation issues. And this is across the Americas. In Canada, we have a long history of dealing with consultation. Most people are fairly familiar with, but a bit of uncertainty has been added by BC and the federal government adopting UNDRIP, the United Nations Declaration on the Rights of Indigenous People. And UNDRIP includes a requirement that governments respect some significant principles, including self-determination, right to redress, and the most debated principle, free, prior, and informed consent, sometimes referred to as FPIC, of indigenous groups in situations where the government's contemplating actions that will adversely affect them. And just last month, the Canadian government issued a road plan for the 181 action items it needs to undertake from 2023 to 2028 to implement the UNDRIP principles. It's worth a read. It's fairly extensive. Now, early statements from the federal government have been that FPIC doesn't mean veto. What it means is meaningful in-depth consultation. And there's been suggestion that the government will be taking a limited view of the effect of UNDRIP on traditional Canadian consultation mechanisms. The problem is, of course, that's all well and good for the feds to say that. They're not the ones who decide. It's the courts. What the courts say. Well, the lower courts have acknowledged that there's conflict between UNDRIP and Canadian common law, particularly in the context of assessing and proving Aboriginal title. And the lower courts have been very careful not to make any rulings with respect to whether the common law or UNDRIP takes priority. They are leaving that for the Supreme Court to handle themselves. So it will be determined in the future. But the lower courts have noted that even if UNDRIP is simply a statement of future intent and a bit of window dressing, it certainly supports a robust interpretation of Aboriginal rights. So Aboriginal consultation rights in Canada may change with the adoption of UNDRIP, but they're only changing in one direction, in that they'll be more robust. Now, we've seen Aboriginal consultation issues stop dead in their tracks mining operations in other countries in the Americas. Most notably, Guatemala, as previously mentioned, overturned the operating license for the Escobal mine, the Tahoe, on the grounds that the local Xinca indigenous community was not consulted, and that was an ILO 169 requirement. Guatemala is undertaking a court-ordered consultation. It's taking some time, but they're proceeding in good faith. They've had lots of meetings, good uptake by the community. And interestingly, a second project in Guatemala that was halted for exactly the same issue went through consultation and is back up and running this week. So Guatemala seems to be following the Canadian model. Things are a little different in Mexico. In 2022, Mexico's Supreme Court ruled that its own Ministry of the Economy should have undertaken indigenous consultation at the time it was granting exploration concessions 20 years previously, and that by failing to do so, it ordered that the ministry declare mineral titles held by a junior in Vancouver called Almaden Minerals ineffective, and that the government could reissue them following consultation with indigenous communities. Now, the government of Mexico initially made noises that they were going to engage in consultation, but there was a change in the ministry of the minister, very anti-mining, and her position was that they would simply cancel the concessions rather than undertake consultation. So quite a different approach. Guatemala, need consultation, government does consultation. Mexico, court says you need consultation, Mexican government won't undertake the consultation, they'll just cancel the licenses. Which brings us to the broader issue of increasing mining nationalization. And Mexico is at the center of the hurricane. On May 8th, Mexico enacted comprehensive changes to its mining and water, and they are extremely aggressive. It reserves most numeral exploration activities in Mexico to the Mexican state. It requires new mining concessions to be granted pursuant to a public tender process. So even if you held the exploration concessions, you may not be the company that ends up developing and operating those concessions. Interestingly, that's taken from the Indian mining system. And as you're probably well aware, there's not a lot of foreign investment in the Indian mining industry simply because of this. There's been a reduction in the duration of mining concessions, new indigenous consultation requirements, not unsurprising given the Almaden case, lots of new environmental safeguards, new bonding requirements, elimination of rights for miners to access surface properties. That's going to make things more difficult, more costly. And then new standards for revocation of concessions, which include an ability to revoke if after 2 years there's no work. These sweeping changes will really hit juniors hardest, as they're going to be unable to basically acquire concessions. And indeed, Since the Morena Party was elected in 2018, no new concessions have been granted. So Mexico is really pushing back against foreign investment within the country, and will no doubt lead to a number of investor-state arbitrations under a variety of arbitration mechanisms. Now, Mexico wasn't content to do that. The mining side, of course, they nationalized their lithium sector as well back in April of this year. Mexico isn't alone in doing that. Chile, which is generally thought of as being a tier one bastion of strength in the mining industry, they announced back in April as well that they'd be nationalizing their lithium industry. And unlike Mexico, which has no lithium mines, Chile right now is the world's second largest producer. So impacts there. Other instances of mining nationalism, we see there was obviously a fight between First Quantum and the government of Panama. First Quantum had to halt production at Cobre in Panama when the government didn't allow them to load metal at port. Ultimately, they reached an agreement and a new tax arrangement that going forward would guarantee $375 million in taxation to the government of Panama for a 20-year period with possibility for a 20-year extension. And of course, there's always the question of, well, when does the government come back to the well? What this tells you is the importance of, if you do have an opportunity in a jurisdiction to negotiate tax arrangements, make sure that they're as long-term as possible and that the renewal arrangements are very clear, unlike the situation in Panama, unfortunately for First Quantum. We've also seen sort of mining nationalism in a reverse state in Indonesia. Rather than keeping people out, they're trying to keep people in, and they have banned the export of raw materials. There was a full ban on nickel ore in place since January 2020, and Indonesia is a very significant nickel producer. That was expanded to capture bauxite and cobalt in June of this year. In June, they were also supposed to ban the export of copper ore, iron ore, lead, zinc, and anode mud from copper concentrates. But the Indonesian government has decided to delay that until next year. Why is the Indonesian government doing this? They want processing plants within Indonesia. They felt that the state was losing money to processing abroad. Sounds kind of similar to, I don't know, Newfoundland in the 1990s. Indonesia continues to hold by this policy, notwithstanding that the World Trade Organization agreed to a formal EU complaint last year. Indonesia has granted a temporary exception for Freeport, which of course operates the Bradford mine in Irian, one of the world's largest copper deposits. So all of this shows that currently the pendulum is swinging towards mining nationalism away from mining investments. And companies should be cautious when they're operating outside of tier one established mining jurisdictions with a rule of law. And heck, maybe even when they're within those jurisdictions. So those were my observations with respect to transactional and legal trends in the industry. And I will turn off the slideshow and see if there are any questions.
Okay, Fred, thank you very much for fabulous presentation, I have to admit. So thank you. You never disappoint us. You know, I remember you being our first presenter in Vancouver when we launched the MES chapter there. And, it was unfortunate we only had 10 people the first day, but we made it up that second time around. So I was very pleased with that. So first question, and the first question is, actually, first of all, before I read out the first question, if you have questions for Fred, by all means, please jot them down in the chat box, and I'll be more than happy to read them to Fred. So first question, are the seller-friendly T&Cs you're seeing extending to all commodities, or is it more limited? Are they specific to particular country, region, or geographically board?
National security review can apply to any commodity. And we've certainly seen the Canadian government apply national security review to non-critical metals. You know, the most noteworthy instance was the Canadian government kiboshing BHP's proposed hostile bid for potash ore for Saskatchewan. Similarly, we saw the Chinese bid for TMAC Resources shut down as well. So certainly outside of critical minerals, the government of Canada, will take steps where they feel there's a concern. Generally speaking, SOEs and transactions with SOEs will attract concern, whether or not it's critical minerals or not. And it can attract the Canadian government's concern, even when the actual assets themselves aren't in Canada. And we've seen that applied to lithium projects owned by Canadian companies, but the projects themselves are in Latin America. So the application of national security review is quite broad. And your best course of action is, generally speaking, to make an application in your transaction through it all concerned. And more companies are making these applications in connection with M&A deals that are indeed very remote from Canada.
Okay. Second question, what are the trending legal implications of ESG in the mining industry?
Sorry, can you repeat that again, Carl?
What are the trending legal implications of ESG in the mining industry?
I mean, I think there's a host of on the environmental side, the biggest one is as the terms for greenhouse gas emission are now made clearer, companies are going to have to follow them, and they're going to have to make disclosure with respect to their compliance with those standards, and investors are going to look at those closely. If you're not making sufficient progress, you can expect to be penalized with the ballot box. I think that's first stage. With respect to social, we've all seen how disruptive local community opposition to projects can be. In Canada prior to COVID, we had a number of blockades associated with pipeline transactions. And certainly we've seen where unrest in jurisdictions with respect to local communities and mining companies can lead to problems, lawsuits, bad press, costs. So again, that's the social side you have to be aligned to. And then on the governance front, institutional investors will penalize companies that don't have in place good governance. And we see that every year in terms of companies failing to stay on pay votes. We see it in terms of companies that don't have best practices in governance receiving lower director support in connection with their annual general meetings. And it's something that companies just have to understand is basic table stakes these days. If you're not in compliance with basic ISS and Glass-Lewis policies, you're going to get a vote against. If you've got major shareholders who have their own policies, like BlackRock, State Street, Vanguard, all have, you should be in compliance with those policies. And if you're not, expect you're going to get a vote against. Those, I'd say, are the sort of three biggest issues on the ESG front that people have to be concerned.
Great. Next question, are mining companies actively considering all of these defensive moves, or have you seen being more reactive than prepared, or all of these risks identified in a risk register?
One of the things about putting in place a defensive strategy is not to have a black book that you pull off the shelf. That's a bad fact pattern. But having in place confidentiality agreements, those sorts of things, having in place electronic data, that's absolutely fair game. Boards have to be aware of it. Most larger, sophisticated companies get presentations on this stuff. Their boards are actively aware of it, and they're thinking about it. I'd say there still are companies that are willfully blind to the threats, and they're the ones who end up being reactive. But I'd say larger, more sophisticated players, build these concerns into their ongoing operations, on a proactive basis. And they also engage, as I said before, the most important thing is a good shareholder engagement campaign. And, most large, sophisticated mining companies have that shareholder engagement and investor relations campaign in place.
Great. Another question. Would you say royalty finance is the new normal?
I did have a slide on royalty finance, and I apologize that I skipped over it. I'd certainly say that royalty finance has gone from alternative finance, which we probably would have called it 10 years ago, to absolutely ordinary course finance. It's expected for more junior companies that are moving along the development curve and beginning to develop projects and take them to production, that there's going to be a royalty. Lenders expect it. The days of fully bankable feasibility studies that get fully financed by banks, those are long gone. There's got to be an equity component, and the royalty companies assist with that. The other thing we're interestingly seeing this past couple of years with royalty companies is it's not just financing operations. Some royalty companies have actually financed acquisitions, and they've been a key player in terms of putting together the cash necessary to get a few deals done. An example of that would be a Sandstorm supported Bear Creek's acquisition of the Mercedes mine from that point. So we're seeing the royalty companies expand their universe of investment techniques beyond just project finance to include some M&A finance as well. And obviously that's welcome for any acquirer who needs to up their offer.
Okay. Next question, and there's quite a bit of questions, so I'm very impressed. Okay, so what would be the position of Canadian government when other countries are subjecting Canadian companies to the same type of NSR scrutiny? Is there a risk that other countries may strip Canadian mining companies from its assets, from its assets in other countries?
I think that when you look at the companies that are on the unfriendly list, particularly China and Russia, they've already done a pretty good job of running the Canadians out of those jurisdictions. So I don't think that that's a significant threat, except to the small minority of Canadian companies still operating there. Certainly, there are other jurisdictions that do this, and CFIUS in the United States has been probably more aggressively hoaxed in the course of the last 5 years than the Canadian Foreign Investment Review. And a number of transactions have been shot down by CFIUS. So Canada isn't the only jurisdiction that's applying this. We've seen other jurisdictions apply. Think of the position that Australia took when Elliott Associates took a run at BHP and wanted them to end their dual ASX London Stock Exchange listing. The government of Australia said hell. So other countries are reacting to foreign entanglements with their local company.
Good. Okay, so another question. What's the reason Canadian mining companies want to override indigenous consultation in other countries, or even worse, CMCs just overrun indigenous rights in other countries, such as building roads in indigenous lands without any consultation? Is it lack of ethics, in your view?
I don't think that you're going to find in Canada many Canadian companies trying to proceed without consultation. Canadian companies understand that that's not the case. I think that part of the problem in foreign jurisdictions is, the Almaden situation. It was 20 years ago that these licenses were granted without consultation. And it was the government's obligation to do the consultation, and the government failed because they didn't treat ejidos as indigenous groups at the time. So a lot of times, these consultation issues the Canadian companies are being tarred with in Latin America are really legacy issues that go back several years. And I think that if Canadian companies were starting over again, acquiring these concessions from day one or engaging in a new permitting process, they'd be adopting consultation standards from the West and consultation standards that we see in Canada. So I think, certainly there have been consultation issues in Latin America outside of Canada. They tend more to be legacy issues than they are current issues. And Canadian companies are certainly a lot better at consultation than Chinese companies or Russian companies where you may have Wagner personnel on site.
Okay, we've got 2 more questions, and then I know you're a busy person, so we'll be mindful of time. Next question. It seems like most ESG investing is in companies that have green credentials like banks and insurance companies who have minimal climate footprint. Is there growing awareness that in order to effect a sustainable transition, investment in natural resource companies and or refiners of the natural resource need money in order to the effect of the changes to their dirty means of production?
Well, I think clearly that's the case. And what we see is investors with sustainable resource funds drawing distinctions between green metals, which may be the red metal, and non-green metals. And, that's the driver for separating out the coal from the base metal at Teck, Glencore, iron ore from base metal at Vale. There's an understanding that some metals that are more integral to the transition to green energy are seen as being better investments. So it's not across the board smearing of the reputation of mining companies. It tends to be those aspects of mining that have high and very significant carbon footprints, and thermal coal is probably the worst. I always wonder why they go after met coal. Everyone needs steel, but obviously it has a significant carbon footprint as well. Whereas lithium battery minerals, viewed on a more friendly basis. Uranium's an interesting cat of a different color. It certainly assists in terms of reducing carbon footprint, but there are safety and environmental concerns, no doubt, exacerbated by the excellent miniseries Chernobyl that enter into it. So some funds think of uranium as green, some funds don't.
Okay, so one last question, but for those who are still sticking around, do stick around for an extra few minutes because I want to show you where exactly you'll be able to find this recording in about a week's time. So bear with us for a few minutes and then we'll let you go on your merry way. Okay, so last but not least, okay, in terms of questions, what are the new trends in finance junior projects?
It's rough out there. It is not a frothy market for junior company finance, and it hasn't been for a while. Opportunities to do, to the extent that they're available, royalty transactions. We've seen a few juniors do them. It tends to be producing companies, near-term companies, but we saw, for example, Wheaton give a finance to Lumen Copper in Ecuador in the last couple of months. Those are opportunities that are available. We see a lot of joint venturing of projects that companies probably wouldn't have joint ventured if it was a frothy market on the finance side. But that's certainly a way to conserve cash. The terms that majors are extracting in connection with those auctions are very significant, and they're different than you would see in strong financing market. They're asking the sun, the moon, and the moon, and a firstborn child or two. But it's a tough market. Where you can get a private placement, do it. Where you can find strategic investors, get them. But I concur with you. It is a difficult market for juniors.
Okay. The last message is, it's not a question, but it's many messages to compliment you on a great presentation today. So one from Alex Davidson basically says, "Great, Fred, great presentation. Thanks very much." And that's the echoing from many other people who said the same thing. Okay, so for those still online,
I'll say a couple other questions that I'll quickly address. Was an NSR done for the sale of Burnett Lake Mine in Manitoba? I'm not aware of it. It probably should have, because the nature of the Chinese acquiring. David Hartwell, hi David. Suicide pacts, tell us more. A gentleman never discusses such things. And then how do you see geopolitics affecting the mining space? Is the world bifurcating into two camps, Western allies versus China and its friends? China and Russia are not a camp as of yet. They are very much antagonists, especially with respect to mining projects. Kazakhstan, if you've worked in projects there, it's an interesting push and pull between Russian interests and Chinese interests. I'd say it's broken down a bit between China and Russia separately, Western interests, and then those countries where there are, significant corruption issues is sort of a fourth bailiwick where, Western companies prefer not to tread. So I think it's not two silos, probably four.
Okay.
And that's all.
Okay. So okay, because you brought that up, what about the Silk Road initiatives that you're seeing? Like, what's your view based on your observation?
I mean, they've been very effective in terms of, China getting influence in countries by standing out infrastructure spending. And infrastructure spending isn't a bad investment. Infrastructure funds pretty good returns. So they're doing well while doing good for their broader strategy. But it's clear that they've linked the two, and it's getting them access to minerals. And it's in that fourth bucket. The countries where foreign corrupt practices, bribery, are more accepted tend to be the ones that are accepting money from the Chinese, but not always.
Okay, so as I promised you, okay, so if you're interested in listen to the recording of this is where you're going to find it. So if you go onto our CIM MES website, so cimmes.org, right, and you click here on national right here, okay, or you can do Toronto or any other, and you go here on the right hand side where you see here highlights from past CIM MES events, right, you will see it will be featured over here, okay, under today's date, right, and you'll be able to access the video, right. So by all means, take a look at this website. In about a week's time, you'll see it posted here, and you'll have access to the recording. Compliments of Fred, so thank you very much for that. Also, if you're so if you were introduced to this event by a friend and you're interested in getting notifications of future events, by all means, let us know, right? So if you were to scroll down here and you click on stay updated at CIM, well, it's really CIM MES, or even this one over here, we will put you on our mailing list. We do not share our mailing list with anyone, okay? So don't worry about that, okay? What we do is we basically keep you abreast of upcoming events, and the more the merrier. Even today's event, we had over 130 people registered for this event, so that's fabulous, okay? So it just shows the interest in the subject matter. On that note also as well, if you have a topic in mind that you would like for consideration to be featured within MES in our discussion group series, please let us know. Shoot us an email, right, through the means that I've noted to you, okay? And we will definitely take it in consideration. We're always looking for great events. We're always looking for great speakers. So if you have somebody in mind, if you have events that you'd like to be featured in future discussion groups, presentations, let us know. Also, we can't do what we do within MES without our volunteers, right? We do a lot across Canada and even beyond Canada. So if you're interested in getting involved with MES, let us know. We're always looking for great talent who's got the time to spare, and is interested in mineral economics and finance. On that note, I want to thank Fred for a fabulous presentation. I want to thank BLG for being a true supporter of MES over the years. I want to thank you, the audience, right? Like I said, over 130 people registered for this event. About 80 people joined us today, so it was really good. And I want to thank our sponsor for this event, IM Gold. We're going to be taking the summer off, right? And but we're going to be coming back in the fall. So stay tuned for future events. Like I said, if you're not registered in if you're not in our mailing list and you want to get notifications of future events, do let us know, and we'll definitely keep you abreast in upcoming events. So on that note, have a fabulous rest of the day. Thank you again, Fred, and thank you all, and we'll see you again soon. Take care. Bye-bye.